John Culbertson, with the Fed on track to raise rates later this year, maybe early next, how are you allocating assets right now? Is a 60-40 split still the right way to go?
It's a good question, Greg. I think it's important to take a step back and talk about the environment. We've been in a world where central bank intervention has probably distorted asset prices substantially, where they're not clearing at market prices. And what are the effects of that? So you have a situation where, at best, stocks and bonds are fully valued, potentially overvalued, substantially overvalued. If you look at something as simple as the Sharpe ratio on the S&P 500 for the last 3 to 5 years, it's probably the highest it's ever been, well north of 1, potentially 2. That's not sustainable. We've had what I call systematic volatility suppression by the central banks. It's in their best interest to keep volatility low, allow us to grow out of what was the financial crisis. There are implications of when this stimulus is slowly pulled away from the market. So what does that mean? It means that, as the Fed backs off, volatility will probably pick up. It means there's risks of dislocation. It means that the investor and the advisor is really stuck with a tough question, a very difficult question, because if both stocks and bonds suddenly look correlated to each other and they look overvalued, where should an investor turn? And lastly, where I think there's a potentially underappreciated risk is the risk of a liquidity crisis. We've had because of Dodd-Frank and Volcker, the investment banks have largely pulled away from risk capital, from committing balance sheets to, particularly in the bond markets. By some measures, the balance sheets are reduced by 70 or 80%. At the same time, you've had corporate debt issuance probably go up by $3.5 trillion. So what happens when people go run for the exits? And who are the owners of this debt? Who are the buyers of this debt? A large portion of it is in the form of a mutual fund or an ETF. And I think there's a substantial risk of a dislocation where the liquidity of the structure is mismatched with the liquidity of the securities. So you combine that with the most likely fact that we're at a point of inflection with the Fed, probably not with other central banks, but with the Fed, we're probably at a point of inflection. We've had a 25 or 30-year bull market in bonds. What happens when those things collide?
So how can investors protect themselves from whatever happens? Because you're not painting a particularly rosy picture.
I think it's very tough, but I think the key will be to find other strategies that are uncorrelated to traditional 60-40 portfolios. Easy to say, really hard to execute on. The key is to find returns that are generated by truly idiosyncratic, truly uncorrelated approaches. So one, for example, is Context is in the process of launching a mutual fund called Context Macro Opportunities. The sub-advisor is called First Principles Capital Management, institutional bond manager, been around for about 10 years. Their strategy and the strategy of the fund is to look for fundamentally inexpensive assets and trade them in a relative value way to each other, but doing so in a way that allows for positive correlation to volatility. You have a positive skew of returns. That is done by very tight risk control, a very patient approach to investing, and an understanding of the optionality that's built in some of these instruments. So in a normal market environment, this fund should be a 2 to 3% returning vehicle. In a higher market volatility environment, it should be much higher than that. Strategies like that, I think, is where investors should look for a diversification of the portfolio.
And how much of an investor's portfolio should they put in an alternative strategy right now? Because, once again, the picture you're painting is pretty dour when it comes to both stocks and bonds. So if there's nowhere to run, should people go all in with a hedge fund?
Yeah, absolutely not. And that is a question that can only be answered by someone's personal investment advisor, because it's very much dictated by risk preferences, risk tolerances, and other goals that are set by the investor. But typically, it's somewhere in the range of 10 to 15 or 20%. But it really depends on the risk tolerance of the investor and their time frame.
And then finally, what can keep this liquidity crisis that you foresee from occurring? Is there something, you repeal Dodd-Frank, if Janet Yellen does something or doesn't do something, what saves us from going down this hole?
That's a great question, Greg. So I do believe that there will be long-term buyers of instruments that will step in to provide liquidity. Insurance companies, larger pools of capital that have longer time frames, that are much less sensitive to day-to-day fluctuations. I think those pools of capital eventually step in and provide liquidity. But I think getting from here to there could be a pretty bumpy ride.
Okay, thanks a lot, John.
Thank you, Greg. It's a pleasure.